Seeing Machines, listed on AIM under the ticker C, has just secured a new driver monitoring contract with a European car maker worth around $5 million in lifetime revenue. On the same day, the company confirmed a separate Japanese OEM award through Mitsubishi Electric Mobility, pushing its cumulative automotive program value past $400 million. The question is why a loss-making company keeps winning contracts at this pace right now. The provisional answer lies in one design choice. Seeing Machines builds its driver monitoring system into the rearview mirror rather than the dashboard or steering column. That architecture is what lets Tier 1 suppliers roll the same system across multiple vehicle platforms with less engineering rework. Whether that answers the deeper question of profitability is the tension this video resolves. The European Union's General Safety Regulation is the forcing mechanism behind this wave of orders, requiring camera-based driver monitoring on new vehicles from July 2026. Car makers that treated the technology as optional are now specifying it as mandatory equipment. That regulatory deadline is closing in, and it is what is compressing years of adoption into a single ordering cycle.
This chapter picks up where the deal left off, because the mirror-based approach is not just a technical detail. It is the reason the order book is compounding rather than growing linearly. Chief Executive Paul McGlone described the architecture as letting manufacturers scale deployment across several platforms without redesigning each one. Over 4 million vehicles equipped with the technology are already on the road as of the first quarter. The same architecture is why an existing European Tier 1 customer just expanded its relationship, adding roughly $10 million in initial lifetime value tied to a new semi-automation feature, while the fresh Japanese OEM contract adds another $1.6 million separately. Two different customer relationships, moving through the same design, both scaling in the same direction. Management now expects existing programs to be extended and expanded as the July deadline approaches. So, the Minimer architecture explains how the pipeline scales this fast, and that answers the first question this video raised. But it does not answer whether that scaling ever turns into cash the company can keep, and that is the question the next chapter has to confront directly.
Here is the assumption buried inside every headline about this $400 million figure. It treats contracted lifetime value as though it were equivalent to profitability. The company's own disclosure says otherwise, stating plainly that its investment profile remains constrained by ongoing losses, negative operating cash flow, and a negative net profit margin. A $400 million pipeline and a negative cash flow statement are describing the same company from two different clocks. The majority of this pipeline's value is not scheduled to convert until 2028, when production actually begins on these new platforms, and some programs run through to 2031. That means the $400 million figure is a multi-year revenue claim, not a near-term cash signal, which is exactly why the company pays no dividend, and why technical indicators remain only neutral to positive despite the order stream. This becomes an entry setup for a watcher if the July 2026 regulation deadline forces the anticipated wave of program extensions to convert into confirmed revenue on schedule, validating that the pipeline growth is accelerating faster than the cash burn. It becomes a trap for a holder if operating cash flow keeps deteriorating, while most contracted value stays pinned to 2028 and beyond, meaning the order book grows on paper, while the balance sheet does not improve in the meantime. For a current holder, the trigger to watch is the next operating cash flow disclosure, since that is the earliest signal of whether losses are narrowing ahead of the 2028 production ramp. For a watcher on the sidelines, the same cash flow print is the checkpoint to confirm before entering, rather than reacting to headline pipeline figures alone. That is the single number that decides which reading of this $400 million order book turns out to be right.